Good morning, everyone. Thank you for your attendance. It's a pleasure to host you in our office and to discuss the CE market and the impressive performance thereof in 2017, and also the outlooks for 2018. And as Richard said, in anticipation of the panel discussion, sort of to set the scene, we've prepared a short research summary that basically summarizes the development and the performance of the market last year and discusses the forecasts for next year, and we certainly do expect it to be some more exciting times ahead. If we look historically at the investment volumes, and I have to point out that we're very early in the year, so we're still collating the data for 2017, but it seems that overall the performance of the CEE market and as a whole will be very similar to 2016 levels, when we had 12.2 billion euros in closed deals. I think last year will be there or thereabouts, so it will be more or less in the between 11 and 12 billion euro range. And it seems that we are actually reaching a cyclical peak. If we look at the figures for CE as a whole, it seems that we've got two main countries, Czech Republic and Poland. They've been at the forefront of investment activity over the last years, but particularly over the last 12 months, we have seen the emergence of Czech Republic. This was owing to a few big deals, and they've really stepped up in terms of the volumes. But we see Poland going strong, and I think end of last year will show that this was another superb, stellar performance by the market, and one that has created price appreciation and a lot of liquidity as well. One of the main drivers of the increase of flows is obviously the cross-border activity that involves both portfolios as well as platforms, which is becoming a more and more important component for the region as a whole, as it increases in its importance in the overall European picture. And we expect to see those continue to the extent the product is available. If you look at the asset classes, retail investment continues to be the number one choice for investors, but we also see that office continues to maintain a steady share at around a third of the overall volume. But the most interesting thing is that the other alternatives are getting more and more traction and interest from the investors. When we look at the comparison between the EMEA transaction volumes and CEE, we see that for the first time ever, the dynamics of the growth of CEE has outperformed the EMEA, and I think that obviously one of the reasons is Brexit, but also the below par performance of Spain and Italy. But I think this reflects the sentiment in the sense that CEE is perceived as one of the key markets going forward, and even though its share in the overall volume, European volume, is still rather small, but it has increased from 3% to 4.5% over the last few years. And in fact, we see more and more investors actually highlighting the CEE region as a core market, in parentheses, but still I think given the increase in liquidity and improvement of pricing, we see that it is slowly being considered as a definitely more mature market, which is also reflected in the setup composition of investors. Obviously, we have the usual suspects from the UK and the US that have continued to deploy capital and recycle it in the CEE, but the very encouraging news is the inflow of new money. We see, particularly from the Far East, and in the case of Poland specifically, it is the surrounding CEE countries that are going for the first investments in Poland. I think it's a very encouraging sign that increases the diversity of the capital pool in Poland, and this is particularly important as Poland, as you know, still does not have a strong institutional capital base. The works on the REIT legislations have somewhat been delayed, so it is unclear in what shape they will be finally delivered and when. That's why the new capital pool from the countries surrounding us created an additional layer of liquidity, which is then reflected in a positive impact on pricing, and I'll show you that a couple of slides later on. And another thing that's particularly important and interesting is that if you look at the composition, a third of the capital is actually that has been deployed within CE actually comes from within. So it is a a significant pool of money that is expected only to increase. In terms of the new players, I think it's very important to point out the growing importance of South African players on the Polish market, and they've deployed more than 2.5 billion of capital into the market, and the figure is growing. So obviously, in a time where the more traditional German buyers are definitely more selective, looking at the assets in Poland, possibly given the dynamic nature of the market, we see new capital that replaces it, and this is at no cost in terms of liquidity or in fact pricing, which has moved in across all markets. Budapest and Sofia have been the biggest examples, the most prominent examples of an inward yield movement, and the scenario is always the same. It's first an increase of liquidity, and then we have growing value appreciation. We see that Romania is probably the next market that will see capital appreciation ensuing rather quickly. We see a lot of investors that have so far stayed outside of Romania, that this is the next hotspot that they are looking for, and it seems to us that 2018 will be a year where we'll see a lot of investment activity in Romania, and this activity will be to a large extent driven by more core players. In terms of the capital values, they have increased, perhaps. With the exception of Warsaw, where we actually have seen yields move in. However, the downward pressure on rent has kept the capital values maybe not intact, but they haven't fluctuated so much. So, in conclusion, we see the pricing moving in. That there are pockets of or markets that will benefit from it more. I'm thinking more about Bucharest and Sofia, whereas others we can see a correction, but it will not be as evident, also due to the increasing pressure on rate increases that you can see here. I think this is probably one of the indications where we are in the cycle. We see that I think there will come a time in a rather not too distant future where the yields or the inward yield movement will be somehow hindered by the adjustment of interest rates. We've seen Romania increase the rates yesterday. Czech Republic have done it twice, and I think that the yield gap is still there. But I think we've come to a point where there'll be more and more pressure closing the gap. And then more specifically into Poland. Poland has been the driver of growth for the last 5 years, in fact. And what we see over here is the potential notional transaction volume in 2017. We now know that this will probably be a figure that's somewhere between 4.2 and 4.5 billion euros, according to our preliminary estimates. So it will not be another breakthrough year. But I think what's important is that the market has managed to maintain the volume, which is rather substantial. At the same time, attracting new sources of capital. So it's not repetition. It's actually reinventing the market in the sense that some of the landmark deals have been concluded by new players and new sources of money. And we see that the investors again are looking away into other alternative asset classes. And another trend that has been very prevalent in 2017 is that it seems that Poland has been underwritten as a whole. Back in 2011, in terms of the distribution of investment volume, we had 20% allocated to regional cities, 80% to Warsaw. Over the last 2 years, we see that the trend has basically reversed, which means that the vast majority of capital now goes into regional cities, and the investors are willing to move up the yield curve. So I think Poland will maintain its status as the core market, and the figures that you've seen on the CEE volumes will again be driven by Poland going forward. But the great thing is that we see other countries contributing more and more to the picture. In terms of pricing, it kept moving in Poland across the main asset classes. So you see that in terms of office in Warsaw, we're at low fives, and there is maybe a bigger divergence in other markets. But in principle, despite the market, which I think we would all acknowledge is rather dynamic, both on the occupier side as well as on the development side, still supports yields moving in at least to a certain extent. But then again, this will be largely driven again next year by the macro policies as well as the dynamics on the occupier market. But I think the investors still acknowledge that there is a bit of a cushion for the yields to move in for the grade A assets. In conclusion, I think 2018 will continue to be a very positive year for CEE. I think everyone acknowledges the fact that the mid-term growth, which is fueled largely by consumption, is still there. The effect of interest rate increases will not be as immediate, so we'll still have that bit of a cushion. We see that there is new pockets of money coming into Poland, and basically the geographical origin is very diverse. So it is from Far East, but also from North America as well, and they will keep the momentum going, at least in the short term. In terms of the negative aspects, obviously there is the danger of inflation increasing, but also on the other hand there is the political uncertainty, that there are the EU discussions about the overall approach to the European community. We see that I think that the negotiations about Article 7 are ongoing, and as I understand, Prime Minister Morawiecki is also traveling to Brussels today to talk to the European Commission leaders with regard to this aspect, as well as the discussions on the future EU budget post 2021, which is about to be opened. And obviously there are some other macro risks involved that could impact the overall performance of the market. But in conclusion, looking at what has happened over the last 12 months and looking at the transactions which are in motion, which have not been affected by the uncertainty, by the possibility of the yield gap closing, lead us to a conclusion that 2018 will still be a strong year, and that the star of CEE will continue to shine, and in fact this will become a more and more important market along the lines of some of the investors who are already saying that we are approaching a status of the more mature markets, and definitely scalable enough to make it work in the long term.